Well, lots of economic data out this morning and lots of great news offsetting the disappointment with housing starts. The one report, though, that speaks most about politics and policies and their impact on optimism with the public, the Michigan Consumer Sentiment Index. It rose to a 14-year high as folks are thrilled with current conditions. Major milestones include 59% saying that their financial progress is doing very well. That's the highest level in the history of this report. Income gains also at their highest level in 50 years. Now, interestingly, the report shows a major bifurcation in optimism among households. The incomes in the bottom third reported an almost 16 percentage point increase in optimism. That is huge versus those in the top third seeing a 7% decline in optimism. No doubt this reflects real changes in fortunes of Main Street and anxiety among elites that President Trump might upset the status quo too much with things like tariffs. This also explains perhaps why expectations, that component, was down slightly. Now, one reason Main Street optimism is high, also jobs are soaring. The JOLTS report showed a remarkable 645,000 monthly increase in job openings in January to an all-time high of 6.3 million. Construction job openings popped to 250,000, up 68% month over month. Manufacturing at 427,000, up 14%. The market is higher on that news, but I got to tell you, in my mind, as long as the Dow trades between 25,700 and 23,860, these day-to-day bounces are going to be crazy, and they will ignore real news. You shouldn't though, because there's some clear winners that are developing for the next leg of this rally to emerge. Now with market reaction, let's go to John Tabacco, Aaron Gibbs, and Scott Martin. Scott, I'll go to you first since you're on remote.
Yeah, Charles, I think this is a good scene for the markets. As you mentioned, there's a lot of positive data. I agree with you, though. I do think there's a catalyst coming up here. Now, it's probably Q1 earnings, which start in earnest in April. So that's probably your next leg higher. But we're expecting a good earnings report, a good earnings season again to come through. And that's why you want to stick with the leaders, though, in the meantime. I love looking at cash flow in some of the big tech companies. Obviously, top line revenue looks really strong in these companies. So the Facebooks, the Microsofts, the Apples, the Amazons, those are companies we own going into Q1 earnings. You
know, Aaron, maybe I'm spoiled, but I don't know if I want to wait to April for a decisive move. Right? Right? I mean, listen, most investors are like, last year it just kept going straight up. Now we got to wait a few months.
Yeah, and we have to sort of hover in this range after that big drop. And, you know, 1 week we're up and the next week we're down. And we really had 4 weeks of these switchbacks. And for us, I really do see that difference. I was just speaking at a conference earlier this week, and you definitely see this very sanguine economic backdrop that's making most investors feel very good. But for those of us that are really have to think about what's coming ahead, this trade war is really concerning for us. And we saw a big drop in industrials. Boeing really got slammed this week. You know, we're definitely worried about rising manufacturing costs and if this incredible profitability could come to a decrease for pretty big industries.
Ironically, the other side of that, though, John, is that the Russell 2000 has held up pretty good, a reflection that maybe the domestic economy would love to see a rebalancing of trade and maybe more manufacturing and things like that in America. But for the market itself, what do you make of it?
You know, Charles, going all the way back right after the election in 2017, I was on Fox Business and I was talking about how Trump's policies of reforming regulation, of cutting taxes, and Larry Kudlow and Stephen Moore's policies of supply-side economics would really be a turbocharge to the market. I thought the market would be 25,000 by this time.
Yeah, but we're there. Now where are we going to go?
Yeah, well, what I see in these numbers, like you said, they're monstrous. What I see is those tax cuts are already coming into effect in the sentiment report because small businesses are out there and creating job openings. I see regulation reform in there in the construction jobs with that huge move. I think 80% of the small businesses in America are the employers of most Americans. And I think small businesses now say, hey, I have a fair shot. I have more money in my pocketbook. I have more money in my paycheck. And I take that extra money and I can grow my business. And I think it's all about growth right now. I think that's the event.
Right, Aaron, you talk about trade and perhaps a cost increase. Where does the market fear most? Because it was only a couple of weeks ago we were afraid of inflation and things being too good, and now we're afraid of things, well, maybe deflation or I don't know. I mean, it feels like almost every other day there's a new worry out there, and we ignore what's really happening, at least from the data.
Yeah, it really is. It's very much about a lot of political headlines, and so certainly interest rates as well. And then ultimately the really great economic backdrop and these phenomenal profit growth that we're looking for. So yes, manufacturing costs could go up, and that would definitely hurt the industrials by by most part. But the rest of the market, the other 85%, that's looking particularly really spectacular.
Right.
We're looking at those great profit growths.
You know, of course, I think with the Boeing, it's not necessarily manufacturing. It's just that Asia, Scotty, is their big market, right? I mean, that's where it is. That's where their exports are going. That's where their growth is going to be. But besides that, because Boeing was $159 on Inauguration Day and recently hit $365, if they've got to give some of that back, then so be it. The broader market, to Aaron's point, beyond those leaders that you watch and that you're invested in, will other names start to emerge, or will it just be 4 or 5 stocks that are just sort of pulling the load?
You know, Charles, we started to look at financials as interest rates have backed up a bit, but even those have calmed down. I mean, to your points earlier about inflation, I mean, look, everybody was concerned that interest rates were going to take off, and they've kind of settled in here, 280 or so, 285 on the 10-year, so that's kind of encouraging. Yeah, the multinationals, I mean, looking overseas where all their growth is, obviously a trade war is very concerning, but I think a lot of this is talk. I think a lot of these tariffs and all these discussions are going to be worked out in some way, shape, or form. They're still going to be favorable, so I would use these pullbacks in Boeing and so forth to add to those positions.
Yeah, Aaron, on that point, even the word coming out of the Trump administration, whether it's $60 billion in tariffs or the ultimate goal of taking $100 billion up to $370 billion deficit out, that's an acknowledgement that there always will be a sort of imbalance. And that's a nod to free trade. I think what we're trying to get here is sort of a free trade, fair trade, where companies in China or India aren't subsidized by 100% or 200%, because then that really tilts the playing field.
Certainly, it's just our concern is that besides the trade deficit, when you look at the size of the equity market, so, you're talking trade deficits versus equity, you're protecting an industry that's 30 basis points of the entire S&P 500. So that may change your trade deficit, but ultimately you're protecting just a tiny bit of what investors have. And so having a trade war where 1/3 of revenues come from outside the U.S., and that could potentially impact a much greiter percentage, is what we're concerned about.
Right. And of course, John, the reason I think Scott is right, China sold us $500 billion worth of stuff last year, and they decided not to sell it to us. And I don't know what the new emperor is going to do with his grand schemes and ambitions. But having said that, another thing the market's going to be looking at is this Fed meeting, right? The first big Fed meeting. We know there'll be a rate hike, but everyone's going to be on pins and needles and how Jerome Powell articulates his message going forward.
Yeah, you know what, Charles? I've been saying for a while now that I thought increased rates would actually be good for small businesses, because small businesses under Obama, with the zero interest rate policy, had no access to capital. And I've been feeling like community banks that I'm talking to now see that there's a spread. They want to see the rates a little higher. There may be some inflation. That's good. But all those people in that JOLTS report who are getting new jobs, they're going to be out spending money. They'll pay a couple bucks more. The way I see it is Main Street USA, they want to see more money in their pocket. They want to see more money in their take-home, and they don't really care about tariffs.
Yeah, in that Michigan number today, 1/5 of people unsolicited mentioned tariffs. But again, I think that was a higher end. Uncanny, unremarkable. Almost 16% of folks at the lower end of the economic spectrum, Scott, feel so much more better about where we're going as an economy. And, so you've got two things in here. You've got Wall Street and the elitists who want things to be sort of the status quo. And you've got Main Street who looks like they want things to be shaken up here.
Yeah, well, I think there's finally some trickle-down effect. I mean, you want to call them crumbs or what have you. They're getting down to the bottom lines, and they're getting throughout the economy. And that's the big thing, I think, going forward. To John's point, is that you're going to see everybody, Charles, benefit from the deregulation, from the tax policy, and that's what the administration promised us. And that's showing up throughout the S&P and the small caps.
All right. Thank you all very, very much. Really appreciate it. Next.